Hi, greetings from Archaeversity. This is Professor Ramkrishna. Welcome to my YouTube channel Archaeversity. And you can also download playlists of my video lectures from archaeversity.com. So in my previous lecture, I explained you how to generalize basic accounting transactions, where you have only two items or two accounts involved in each transaction, and mostly they are on a basis of a cash or a credit. In this lecture, I am going to extend that and by explaining you how to generalize advanced journal entries or how to generalize advanced transactions in general journal. So without any delay, I'll take you to my OneNote where I have 10 examples with a different context, which helps you to master the art of generalizing accounting transactions. This lecture may take some time, but I suggest you to watch the lecture from the beginning to end very keenly, so that this will help you to generalize the transactions without any errors. First, let me write the rules of a debit and credit for different classification of accounts. So when I say you have assets, you have a debit and a credit. When there is an increase in asset, we debit it. When there is a decrease in asset, we credit. On the other hand, when it comes to the liabilities, when there is an increase in a liability, we credit it, and when there is a decrease in a liability, we debit it. Similarly, when it comes to the equity or owner's equity, capital or something, so debit and credit, when there is an increase in equity, we credit it, and when there is a decrease in equity, we debit it. Now when it comes to the expenses, when your expenses increase, we debit, or expenses decrease, we credit. On the other side, when it comes to revenue, on the other side, when revenue increases, we credit, and when revenue decreases, we debit. And the rules of writing generalizing transactions is that first, in each transaction, you have to check whether this transaction has of a financial character or not. This is the first thing that you have to look at each transaction. Second is identify the accounts. That is, there may be a minimum, there will be two accounts. So two accounts or more. Then in the third step, classify these accounts as asset, liability, equity, revenue or expense. Then fourth, apply rules of debit and credit using these rules of debit and credit. Then in the fifth stage, generalize the transaction, and sixth step is to write a narration to each transaction that you generalized. So these are the series of steps that you have to follow. First is check whether the transaction is of financial character or not. Identify the accounts. Minimum two accounts will be there. There is sometimes more accounts. Then classify those accounts as assets, liabilities, equity, revenue, expenditure. Then apply the rule of a debit credit, generalize this transaction, and write a narration. So here we look at the transactions. As I said, this lecture explains you 10 different transactions, which will covers almost all of the advanced journal entries. Now on October 2nd, Travel Guide received rupees 10,000 cash advance from Mr. Trilok for guide services that are expected in December. So that means here you have a two. One is you received the advance amount, and that too in the form of a cash. Why we are saying this as an advance is you have not performed the transaction or you have not performed the service at this point of a time. So this, we call this as a unearned income. right? So you have advance and you received a cash. Advance is your liability because you have not performed the service, you simply took the advance. So in future, if you are not able to make the or provide the services, then you have to repay. That's the reason why you owe money to travel guide. So you owe money to Mr. Trilok, and cash is an asset. So here what happening to your advance amount liability? There is an increase in a liability. There is also increase in your asset. So when asset increases, what is that we do? So check here, asset increases, will debit. Then what is that we do with the liability? When there is an increase in a liability, check here, we credit. So we'll write the transaction like this. That is on October 2nd. Now on 2nd October, our transaction will be, so we are receiving the cash. So there is an increase in asset, so we debit. So what is that we do is cash account debtor to your unearned income or advance. Let us say we'll write this as a unearned income account. So how much is the amount? 10,000 and 10,000. So here you can write a narration. Advance amount received from Mr. Trilok for the services to be delivered in December. So this is a narration that we write. So what is that we did? First is we identified whether this transaction is of financial character or not. Then we identified the two accounts. One is the advances, that is the unearned income. Second one is the cash. And we classified it as the two accounts, liability and asset, increase in liability and increase in asset. Applied the rule of a debit and credit. Then journalize the transaction. So cash account debtor to unearned income. Then we wrote the narration. So all the 6 steps are performed here. Now coming to the next. On October 10, travel guide paid rupees 6,000 for 1 year insurance policy that will expire next year on September 30. So here you have two things. One is you paid in the form of a cash. Then you prepaid the expenditure. In the sense, before incurring that expenditure, you paid it. So cash is your asset and prepaid expenditure is also an asset, because insurance company owes you this money. In the sense, tomorrow if you cancel your insurance policy, the company has to repay back this money. So here prepaid insurance is also an asset. Now what is happening with the cash? There is a decrease in a cash. So your asset decreased. On the other side, prepaid expenditure is an asset because you own this money from the insurance company. So this asset increase. So increase in asset is debit and decrease in asset is a credit. We applied the rules. Then we journalize the transaction. October 10. Then what is the debit? Prepaid insurance account debtor to cash account. And how much is the amount? Rupees 6,000. And now here we write a narration saying that insurance paid in advance for next 12 months. So this is a narration. Now coming to another transaction. On October 10, travel guide hired 4 employees to begin work on October 15th. Each employee will receive a weekly salary of rupees 1,000 payable every 2 weeks. First payment to be made on October 26th. Now here we simply entered into an agreement and we are not sure that whether these employees are going to start their work on October 15th or not, because now we are into October 10th. So this is, as this is a simply an agreement and it is not of a financial character, we will not journalize this transaction. So we will not journalize this transaction because this transaction is of no financial character. The next, on October 12th, travel guide purchased on account. When you say that on account, this is a credit. Supplies from Messrs. Supply and Co. with a list price of rupees 22,000. The price is 22,000. So here, what are the two accounts involved? One is you purchased the supplies. So let us say your purchases. Then you purchase this on a credit from Messrs. Supply and Co. So Supply and Co. is a liability because you have not paid this amount, you have to pay them. So this is a liability, and purchase is an expenditure. Now what happened to your expenditure? There is an increase in expenditure. And what happened to supply company? There is a liability, there is an increase in a liability. When liability increases, what is that we do? We credit the account, and when your expenses increase, we debit. So here what is that we write is October 12, then your purchases account debtor to, let us say supplies, we make this as a payables, that is trade payables or trade payables, or you can also write as a creditors. So we use the word payables. Now the amount is 22,000, and we write a narration. Supplies purchased on credit from Messrs. Supply and Company. So the narration is also done. Next, on October 13th, travel guide sold on account. When you say that on account, again this is a credit. Merchandise with a list price of rupees 24,000 to party pal. So one is your sales and second one is your party pal, that is your receivables, in the sense party pal has to pay you the money. So sales is your revenue, receivables is your asset. Now what is happened to the asset? Asset increase, sales also increase. When asset increases, we debit, and when revenue increases, we credit. So how is that we are going to write a transaction for this is on October 13, your journal entry is receivables, that is a trade receivables or debtors account debited, that is debtor to your sales, that is a credit sales. Now what is the amount? Amount is 24,000 rupees. Now you can write here credit sales made to Messrs. Party Pal. Now on October 14th, travel guide returned supplies to Messrs. Supply and Co. worth rupees 2,000. So here two things. One is your Supply Co. You purchased goods from Supply Co. Here you can see here on travel guide purchased on account supplies from Messrs. Supply. So and you created an account called as a payables, and this is your purchases. Now what is that you are doing now? You are returning. So this is a purchase return is one, and second is the payable. Now what is happening to your payable amount? When you are returning a goods, your payable, that is your liability, will increase or decrease. So instead of paying a 22,000, now you are supposed to pay only 20,000, that is 2,000 you are returning. So there is a decrease in a liability. And purchase returns. So what is that you are having here? Your expenditure. So purchases are your expenditure. And what is happening to your purchases? You are returning them. So when that is, your purchases will also decrease. Now when liability decreases, what is that we do? We debit. And when expenditure decreases, what is that we do? We credit. Now you can check here. So when there is a decrease in a liability, we debit here. When there is a decrease in expenses, we credit. The entry will be, that is your general transaction is on October 14th. So which account to be debited? That is payables. Payables account debtor to purchase returns, or you can say return outwards also. The amount is rupees 2,000. Now you can write here supplies worth rupees 2,000 returned to Messrs Supply and Company. Now on October 16th, Party Pal returned merchandise of rupees 4,000. So here is what is happening. Sales returns. You made a sale to a Party Pal on credit basis and now they are returning you. One is the sales returns and second one is your receivables, because you sold this on a credit, so they owe you money, or you own money from Party Pal, so that is a receivable. So your receivables is an asset, sales is a revenue. Now what is happening to your asset? Your asset is decreasing. Instead of receiving a amount, you are receiving lesser amount, that is 4,000. So there is a decrease in your asset. And sales returns. What is happening? Your sales, that is your revenue, is also decreasing. Now when receivables, that is your asset, decreases, we will credit. And when revenue decreases, we debit. Now check here. When there is a decrease in your asset, we credit. And when there is a decrease in a revenue, we debit. Now using this, we'll write a transaction, that is a journal entry on October 16th. Which account to be debited? Sales returns. So sales returns account debtor to receivables account. And what is the amount? Rupees 4,000. So here we write a narration saying that merchandise worth rupees 4,000 was returned by Messrs Party Pal. On October 22nd, Travel Guide made a payment. So here we made a payment to Messrs Supply and Co. and received 2% cash discount. So one is your payable account, and second one is a discount, that is discount received, and the third one is the cash. So here you are making a payment of a cash. So cash is an asset, payable is a liability, discount, let us say, is a revenue. Now what is happening with your cash? There is a decrease in your cash. So when there is a decrease in your cash, what is that we do? We credit the asset account, or when there is a decrease in asset, we credit it. And here what is happening to your liability? There is a decrease in your liability. So decrease in a liability is a debit. Next is you received the discount. So discount is your revenue. So there is an increase in revenue. When there is an increase in revenue, we credit. So here we have a three accounts. One is a payable account, second one is a discount received, and third one is a cash account. So which account that we have to debit now? Payable. So in our journal entry, that is on October 22nd, the entry is payable account debtor. So how much of the amount that we have to pay to the travel guide? So initially we bought a supplies of worth 22,000, and from this we returned 2,000. So the amount to be paid is 20,000. Now just we can see here. So from a supply co, we purchased 22,000 and then we returned 2,000. So 22,000 minus 2,000 is the 20,000. Now on this, how much discount we are receiving? 2% is the cash discount. So that is 20,000 into 2 by 100. So this comes to the 400 is the cash discount. Now in a payable account, debtor is the total amount, that is the 20,000 to be paid, and one is the discount received. How much discount you received? 400 rupees. Then how much cash you paid? 19,600 is the cash that you paid. So here we write a narration saying that cleared due amount of rupees 20,000 and received discount of rupees 400, and net cash paid is 19,600. So if you sum up this, 19,600 plus 400, this is a 20,000. So this is the discount amount that you received. This particular transaction has three accounts. One is a payable, one is a discount, and second one is a cash discount. Now next is on October 24th, travel guide received payment from party Paul and allowed discount of a 5%. So here one is the cash, then second one is the receivable. Cash is an asset, receivable is an asset, then you allowed the discount. So discount allowed, so this is an business expenditure, so we'll write this as an expenditure. Now receivable as an asset, cash is an asset. So what is happening with your cash? There is an increase, you are receiving a cash, so increase in a cash. Then receivable, another asset, which there is a decrease in another asset. And discount is an expenditure, so there is an increase in your expenditure. Now how much cash that you are receiving? So initially, if you observe here, you sold merchandise of rupees 24,000 to Party Paul, and Party Paul returned 4,000 rupees of a merchandise. That means, so 24,000 is the sale minus 4,000 is the return. So net is 20,000. And on this 20,000, you are allowing a discount of a 5%. So 20,000 and 5 by 100. So this comes to 1,000 rupees. So 1,000 rupees is your discount. So how much cash you are receiving? 20,000 minus 1,000, that is the 19,000 is the cash. Now here increase in asset, debit, then discount allowed expenditure, increase in expenditure is a debit, decrease in asset is a credit. So we generalize this transaction saying that October 24th, which accounts to be debited? One is a cash account debtor. The next one is discount allowed account debtor. So how much is the cash? 19,000, and discount allowed is 1,000 to receivables account and 20,000. So received rupees 19,000 cash and allowed rupees 1,000 discount to Mr. or Mrs. Party Paul. So this is a narration. Alright, and the final transaction is on October 30 sold a used computer for rupees 8,000 which was purchased on October 5th for rupees 9,000 from second sale shop. So here you have a asset which you are selling, that is your computer is one, then second is a cash. Now if you observe here, you purchased this for 9,000 but now you are selling at a 8,000, that means there is a loss. So computer is an asset, cash is an asset, loss is a revenue loss, or we can say that gain or a loss. So this come to your equity holders. So this is a equity. So here computer is an asset and here there is a decrease in a computer. Then cash, there is an increase in cash. Then a loss, this is a decrease in a owner's equity. So when asset decreases, we'll credit it. When asset increases, we debit. And when there is a decrease in owner's equity, we debit. So for this transaction, our journal entry will be October 30. Then which accounts we have to debit? One is that you have a cash account debtor. Then you have a loss, that is your revenue loss account debtor to computer. So how much cash you received? You received a cash of rupees 8,000 and your loss is 1,000. Total value of your asset is 9,000. Now you can write a narration saying here that sold old computer worth of rupees 9,000 for rupees 8,000, and the loss incurred was rupees 1,000. So if you see, the value of a computer is 9,000 here and the cash received is 8,000, loss is 1,000. So total 9,000. So this transaction has 3 entries, or you can say that 3 accounts involved in this. So this is how some of your accounting transactions will have more than 2 accounts. In such a case, you need to be very careful in identifying the accounts, then applying their rules of debit and credit, and then posting them into your books of original entry or general journal. Hope this lecture help you to understand the nuances of advanced journal entries. In my next lecture, I am going to explain you how to write journal entries when your GST is involved, that is a goods and services tax is involved. So when you are making a purchase, you have to in the sense your seller will deduct GST. On the other hand, when you are making a sale, you will deduct the GST. So how is that you have to incorporate those in your journal entries? That is explained in my next lecture. And in the 4th lecture in the journal entry series, I'll explain you the accrual accounting, that is a journal entries in case of a accrual accounting. Thank you for watching the lecture.